Okay, let's do a Q&A from Sunday's Market Outlook. And off the top, let's deal with about 20% of the comments, which were pushback on comments I made. I would like to stay out of politics altogether. You're in the largest financial market in the world. Unfortunately, politics matters. The outcome of this election will have very different consequences for certain asset groups. So you sort of have to be in there. I agree with some of the comments that I should just drop politics altogether. I agree with that. And there was a time when politics just wasn't that interesting. Where if you brought something up, you usually just put people to sleep. It wasn't as consequential as it is now. And I'm going to repeat something that I've said many times. It's because today democracy is broken. We don't have elections. We have popularity contests. And when you have popularity contests, you are voting for, the person who is the more popular person, not necessarily the most qualified person. And that ends up being petty. So how do you end this? How do you end this? I guess you just simply say, look, I'm not going to talk about it anymore, which, I have a bunch of comments here. If I say I'm not going to talk about it anymore, then somebody's going to say, oh, you can't answer, you can't respond, you can't defend yourself, can you? And which I can. But I think a lot of people would rather I just drop it because no one ever gets the last word. I could just reply to all of these, but then there'll just be more replies, right? No one ever gets the last word. So here's what I'm going to do. I'm going to ignore them. If you want me to have a deeper discussion, a longer discussion around the nature of democracy, why I think democracy is broken, why I think both Canada and the US should follow the private equity model, and I'll tell you what the private equity model is here. If you want that, I can do a live feed and concentrate it all there, which means if you don't want to listen to it, you don't have to. I'll keep it out of the finance stuff altogether. But I'll just tell you what the private equity model is, because we do have private equity and no one seems to object about that, right? So let's say you have a publicly traded company. It is a form of democracy. Shareholders get to vote. The shareholders are the owners and they get to vote. And it is one share equals one vote. Not one person, one vote, but one share, one vote. So one person can have many, many shares and pretty much control the show. But they pretty much own the whole thing, so why shouldn't they, right? Sometimes a publicly traded company gets into trouble and it needs to make tough decisions. It needs to make investments for the long term. It needs to do the right thing for the company, but under the watchful eye of the market, where it has to present earnings every 3 months, it's going to get punished. And if it gets punished and its share price gets punished because it's making long-term investments and not short-term results, it's going to lose key managers because a lot of the compensation of these managers is tied to the performance of the stock and stock-based compensation. These companies are then taken private so that they can then fix themselves and sometime in the future they're ready to be introduced to the public markets again. Private equity is a dictatorship. There is no vote. Private equity owns the whole thing. Sometimes you have to do that to fix a bad situation. Democracy, I believe, is broken. At this point, it is broken. And as long as it continues to be popularity contests, both parties trying to get elected by giving away the most free stuff they possibly can. Every day it's something free that's being given away. No one's talking about the deficit. No one's talking about the debt. It's deficits as far as the eye can see and mounting debt, which will destroy the company here being the country. What you need is private equity to come in and take that company, private so it can make the right decisions to save itself. That's where we are. And so do we need private equity to come in and take the country? Yeah. Are either one of these candidates the right candidate to do it? No. I will agree with that straight up. Straight up, I'll say neither one of them are the ones you want doing this. But no matter what you can say about Trump, just walk away with this. No matter what you can say about Trump, everyone knows it. He wants to be a dictator. Yeah. He denied that he lost the election. Yeah. He tried to overthrow it. Yeah. He's a convicted felon. Yeah. He's a pathological liar, a raging narcissist. Yeah, all of that is true. But look at the polls. Look at the betting markets. Next Tuesday, you're more than likely to have a president. Do you believe in democracy, or would you say at that point, well, democracy's broken, the people are stupid, there shouldn't be one vote per person, right? If you want a longer live Q&A about that, I'll do that. But I will follow the advice from a couple of comments of leave the politics out of it and stick with finance. Because I've made the comment about one podcast I listen to that delves into politics too much, and I say, please leave that aside and just, stick with the stuff that you really have insight on. And I agree, I should do the same thing. So I will at this point. So if I skip over the comments about Harris, Trump, all of that stuff, it's not because I cannot defend it or that I'm unwilling to defend it. It's just, given the audience I have, I should give them what they want, which is a look into the finance. And we'll just stay with finance. How's that? If you do want me to do a feed, a live, where it's about politics, I will. I can defend my position, but we'll leave it to something else. So let's go. We'll skip the first one. We'll skip the second one. See, there's a lot of them on here, right? In case you don't know, PIMCO 25 years zero coupon US TIF ZROZ has way more volatility and it's just 5 years longer than TLT for your long duration trade. But I don't need that, right? For zero coupon, I already have a bunch of zero coupons. So I can replicate the duration of TLT with zero coupon. And this is important if you're outside the country. If you're not US, you don't want the withholding on the coupon, right? So you can say, well, TLT has a duration of about 16 to 17. We're in 2024 right now. So add 16 or 17 on, you go to 2041, and you find principal strips, not interest strips, because there's no liquidity in the interest strips, but principal strips. These are zero coupon bonds that mature in 2041 that have a duration of 16 to 17. You get the TLT duration without the management fee, so you get no management fee at all. So you end up with about 100 basis points higher on the yield. Not only that, there is no withholding. If you have TLT with the dividend, there is a withholding, 15% in a tax treaty country, 30% in other countries. Interest, same thing. Here, these are principal strips. There is nothing to withhold because everything is inferred interest. There is no coupon to it whatsoever. So you can whatever fund is giving you duration, you can get your own duration as well. And I do have a bunch of 2041 strips, and I got a bunch of 2048 low coupon bonds. So I do have a bunch of duration on that end of the curve, along with TLT. When you're in strips, you lose the options, right? You get big duration, or you get the same duration as TLT. You don't have any withholding. You don't have any issue like that, but you lose the options. And the options do allow you to earn extra income if you know how to use the options. So that's why I use TLT, because it has very liquid options to use. You invest a lot in fixed income, and let's say in a more conservative portfolio, maybe you do not need to take much risk due to your financial situation now. But how would you invest in the markets if you were in your 30s and had not the same amount of money in the account? On what would be your focus? How would your portfolio look like? So I would probably, I have the luxury of hindsight, so I know what has performed well. So I can't look back and say, well, when I was 30, I would have invested in this, because look at it today. Well, that's kind of child's play, right? There are certain things that have just gone up over time that I think will continue to go up over time. Real estate is one of those. You don't know what the pathway looks like, but it continues to increase. Gold has always done well on a compounded annual growth rate the last 20 years, 12% a year. I think it continues on into the future. But if I had to take one thing, just a fund, one single thing, it would be the S&P 500. 500 of the largest companies in the U.S. It is a it is a rebalancing portfolio because every now and then some companies are kicked out of the index, new companies are brought in, so you don't have to worry about getting rid of the losers and bringing in new winners. That is done for you. And at any point in time, if we look back over a period of time, put a chart of S&P out and go back 10 years, you are always higher. Go back 10 years, you are always higher. So there is a long-term underlying trend to S&P, and sometimes it gets way above that trend, but it comes back down. So, if you buy here, you may have to wait quite some time before you break even. This was the problem with NASDAQ after 2000, is it like 16 years before it hit another high. But if you're in your 30s and you don't need it till your 60s, I would put money in S&P 500, and then every quarter, whatever savings you have, you buy. And if you buy at regular intervals, you will dollar cost average over time, you will get this over time. So that if you buy here and it pulls back, you should get excited because you don't need this money for 30 years over here. And, well, it'll be up there. It's better if you buy here because you got a better return. But you get excited because, well, my next investment, I get to buy, if I'm putting in $3,000 every quarter, $1,000 a month, I get to buy even more shares. And then it pays a dividend. And next time you put money in, you take the dividend, you buy more. If it keeps falling, you get your dividend, you take your money, and you buy more. And it will continue to go up. You will, by dollar cost averaging over a long period of time for a portfolio of winners, because remember now, it rebalances. So for a portfolio of winners, you will do well. And you can go about your life. You can build a business. You can invest in ideas. You can get a job. You can have a career. Whatever the case is, you can focus on your life as opposed to focus on your money. If I were in my 30s, that would be the advice I would give. If I were 30 today, I would say, yeah, the market's overvalued today. But you're not just going to buy once. You're going to invest over a period of time. So don't worry what it is today. In 3 months when you buy, if it's 200 points lower, great. You get to buy at a lower price. You're buying this long-term winning index at a lower price. Pullbacks are seen as opportunities, right? That's what I would do. That would be about the best advice I could give in your 30s. Don't worry about fixed income. Compare the 10-year and 30-year yields with those at the end of July, just before the end. Well, you can't. See, you're picking a time, right? At that time, the market was unaware of the negative news and the end carry trade was still active. The market hadn't yet priced in a recession. Any significant 50 basis points or an additional emergency Fed rating to quickly respond. Only one cut was priced in for September. Now, after 50 basis points, some rates are actually higher. You can't pick like that. It has to, you can't just look at the charts and say, let's go back to this date. I mean, I can do that too. I can find a date where yields were higher and say, oh, but if you go back to March 11th, when you had ideas maybe there'd be more rate increases, yields are actually lower today. I can do the same thing. So you can't really do that. The pathway to get somewhere is unpredictable. I don't know what the pathway is going to be. I have no idea what it's going to be. I just know that in the past, if you take any rate cut and you go out 12 months and you look at where the 30-year is, the 30-year yield versus here, 100% of the time it's lower. Now, you get a rate cut, the 30-year could have done this. The pathway, I have no idea about the pathway. The path to get somewhere is unknown. Beats me. I have no clue. The destination, you have a much better probability of getting the destination right, but the pathway wrong. And I've also said this before. On my picks, I'm about 90% right. On my timing, I'm about 90% wrong. So I take timing out of it. I don't care about time. I think the 30-year yield from the first rate cut now, and only time will tell if I'm right, the first rate cut mid-September. If you go out to 2025, have a look at what the 30-year yield was on this date, the morning of, before they announced the rate cut. Have a look at what the yield was. We could look at what the Tuesday night closing on the 30-year yield was. Go out 12 months, and based on history, the probability is very high that the 30-year yield will be lower, which means the 30-year bond will be higher. It has a track record of doing that, much like the S&P over long periods of time has a track record of going up. It could do this before it does this, and it could do this and then come all the way down. And if you say, "Oh, but you lost a lot," yeah, but that's not what I'm comparing, right? So you can't just pick and choose dates. The relationship I'm showing you here is 12 months out, not let's go pick certain dates, right? So be careful about that. This cherry picking the data. You have to, if you're going to say 12 months, it's 12 months. You have to look at it 12 months over 12 months. This relationship is very solid, and that's what I'm looking at. And again, I get your point, but the pathway is unpredictable. This is why the shorter the orientation you have, the more likely you are to produce random results. So day traders tend to make money, then give it back, then make money, then give it back, then make money, then give it back. Why? Because it's random. It's random. Once you start adopting a longer term orientation, you'll find that your portfolio has less volatility, and you tend to make money over time. That doesn't mean your portfolio value does this every day, right? It just means that you're more likely to achieve this end result from this beginning result if you have that focus. How you get there, who knows, right? But this stuff is the stuff that will knock you around. This is the stuff that will mess you up. All right. Why is the 30-year Treasury yield lower than the 20-year? The 20-year is an odd tenor, right? It was the 10-year is liquid. The 30-year has a clientele effect, but the 20-year really doesn't. The 20-year is just, it's not liquid enough to be the 10, but it's not long-term enough to appeal to the insurance companies and the life insurance companies to be a longer-term hold. It's kind of in the middle of the two. So it doesn't have much of a clientele effect. My old professor said it was due to the Fed moving 30-year Treasury from their balance sheet, removing 30-year Treasury from their balance sheet. But I don't understand what that means or how. I don't know. There are different theories for the shape of the yield curve. One has to do with what's called the clientele effect. That different segments of the curve have different clienteles, that those who play around the 30-year yield really don't mess around with the 2-year. And those that play around the 2 to the 3 to the 4-year don't really mess around with the 30-year or the 10-year. But there are big clientele effects for the 30-year, which is typically life insurance companies and pension funds, endowments. And there's a lot of play around the 10-year. It is the benchmark for mortgages, and it is a pretty popular hedging tool. So it's very, very liquid, probably the most liquid out there beyond the 2-year. But the 20-year, it's like, well, if I'm going for 20, why don't I take 30? It's got the better duration. And if I don't want 30 and I go down to 20, why don't I take the 10? It has more liquidity. It's one of those things where it just doesn't have a very good clientele effect. I mentioned you're surprised by the 50 basis point cut by the BOC in your live session. Excluding shelter, Canada's inflation was 0.4. On a provincial level, if you look at inflation excluding shelter, 4 provinces are experiencing deflation. Manitoba, New Brunswick, Saskatchewan. I feel a large cut was justified. Yeah, at 3:30 today, he was in the Select Committee on Finance on Parliament Hill. That was televised. You had to go to the Parliament's website to get it, but it was televised. And that's exactly what he said. He said, we don't have broad-based inflation anymore. You do have, higher prices here and there, but that's not broad-based inflation anymore. And he did say more cuts are coming. And when he said that, if you were paying attention to the Canadian equities today, right around a little after 3:30, you got a really nice rally into the close. There was a heavy weight on interest rate sensitive securities today. Took a great opportunity to add more REITs and add more Bell. And then after he spoke with more rate cuts coming, off it went to the races. So I think that was good. But 325s. I just felt that if you continued on with 25, it was a good pace. But these 50 basis point cuts, I think sometimes can send the wrong signal. So there was a sort of thinking with the Bank of Canada with the 50 for a while that they did the big cut and maybe they'll be on hold now. Much like the Fed did the big cut, maybe they'll be on hold now. And when he said, no, we're going to keep cutting, interest rate sensitive equities tended to do well on that. I do believe that we are in a world where the backdrop is deflationary. I do believe that. So I'm finding it hard to accept a lot of the analysis out of U.S. investors about how under a particular victory in the U.S. it's going to be inflationary. And there are some good linear explanations of why it would be inflationary. And that's why the long end of the curve is going up, because it's beginning to price that in. I have to push back on that. I know it's some big names that are saying it, but look, last year, around this time, Jamie Dimon was saying you could see, a 6% on the 10-year. I didn't think that was valid. That never happened. And you'd think, but that guy would be in a position to know this stuff, right? I mean, don't you think he'd be in tune with that stuff? I know Paul Tudor Jones is saying it. I know Druckenmiller is saying it. I push back on it. I think they're wrong. I think they're wrong. I think they're underestimating the power of the deflationary aspect of technology and the deflationary aspect of entrepreneurship. We're seeing it there's one particular industry of which I'm very involved in, as you know, and I'm seeing it. I'm seeing the effect of it right now. I pointed out, even today I was pointing out, saying, look at this. This is an issue. This is, in 3 or 4 years, this is going to be a problem. So I'm seeing it. In areas where you'd think, well, okay, you shouldn't be seeing it. If you're talking about shortage of labor, I can show you a place where there's a shortage of talent really easy, and I see pricing pressure on the downside because of technology, because of what AI is starting to do. I think that's being underestimated. The speed at which that is going, at which that comes out. If you have a freely flowing river, by that I mean no supply constraints, right? So the natural flow of the river, the natural flow of capitalism, if you have that in place, that is deflationary. And it has always been deflationary. Constraints are what make it inflationary. And maybe they're suggesting that, well, these tariffs will be constraints which will make it inflationary. I don't think that the tariffs are going to be enough to overcome the wave of technological and entrepreneurial deflation. I think they're mostly wrong. So I do think that the bigger threat in the coming years is deflation. So maybe the Bank of Canada saw that sooner than I was eyeballing it. Both gold and stocks around all-time highs. Any precedent or explanation? It seems odd. It seems odd that there's money running for safety. Money market funds just keep increasing in assets under management. Gold keeps hitting new highs. Bitcoin today was on fire. And equities just keep pulling it out. Today it looked like it was, flirting with the zero line, and then, after hours some companies reported and up it went. Doesn't matter. I don't have an explanation for that. For gold, I can say that, well, here's what's going on there. Yields have been, per ton of ore, have been dropping for some time. And there are no more big gold finds to get. So if you want more gold out of the ground, the price is going to have to go up to turn resources into reserves, period, if you want it to go up. The U.S. move against Russia with their U.S. dollar balances, that probably didn't help the desire for other countries that find themselves on the other side of the U.S. relationship to want to hold U.S. dollars. Because what if it's used as a weapon against them as well? Whereas gold, once you buy the gold and once you bring the gold into your country, that's it. It's yours. It can't be confiscated, right? So the intersection of those two things probably can help explain gold. But, when you look at money, it seems to be searching for safety somewhere, but still going with equities. Maybe the safety that they're looking for is something that favors equities. I am confused a lot on these markets. I've never had a more difficult time with a macro approach. Usually, with a macro approach, there are usually very strong tendencies. There aren't if A then B, but if A, most likely B. But not necessarily, but most likely. Now it's if A, I don't know, maybe B, maybe C, maybe D, maybe none of it, maybe all of it. I don't know. I haven't got a clue. That's where I am now. Is the U.S. dollar going to gain strength or weaken? I haven't got a clue. Are bonds going up or down in the next couple of months? I haven't got a clue. And what's the market going to do today if I told you this was going to happen? No idea. No idea. It has been so hard. And I wish we could go back to the way it was, but maybe this is the new normal. Is that there's so much money out there, and that money has to find a home, that everything can go up. You can have everything rallies. Good news, everything rallies. Bad news, everything rallies. No news, everything rallies. Why? Because there's so much money out there. So much money that has to find a home. And if the Fed has to start buying the debt to yield curve control, to lower the interest expense for the Treasury, you will have everything rallies forever. Everything will go up, in which case valuation no longer matters. The only thing that matters is liquidity. But yeah, that's my best explanation for gold and stocks, without going into a lot of detail, right? You mentioned that you target a risk level instead of return. How do you actually measure and quantify your portfolio risk? You can measure it by how much money you have at risk times the beta, right? So whatever beta it is, times the amount of dollars you have, times the delta if you're using options. You can measure it that way. This is the wild card, right? These things you'll know. Beta is the wild card. Because there could be a very large idiosyncratic portion that is not captured by beta. And the larger that idiosyncratic portion, the more difficult it becomes to try to figure out what is my risk level. So you can use statistical measures. Interactive Brokers gives me my expected shortfall, which is a measure of left tail risk. So you can say, well, I don't want, as a percentage of my liquidation value, my expected shortfall should be less than, 0.05% or 0.5% or something. So you can have some measure like that. But there is no perfect measure for it, because all risk measures are based on historical volatility. So you have to think about, well, what if you get an increase in volatility, then your risk measures aren't going to be the same anymore. Or your risk measures run the risk of not capturing exactly what you want them to capture. So you get as close as you can. I don't know that there's an exact precise thing to look at, but you get as close as you can. And then the more experience you have, the more it's a level of comfort with what's going on, and the size of the positions you have. A lot of information that you are given is similar to what I read in Barron's Wall Street Journal. Do you use the news there as a starting point and then look at companies' macro data in more detail, or is it more a confirmation that you are looking to read about a company that you have in mind before? A lot of information is similar to what I read in Barron's and Wall Street Journal. Well, I'm not sure what information. As far as when I talk about yields, that's right from the Treasury. But if other companies, if other publications are talking about yields, and you say, hey, they've got the same yield curve as you do, well, it's because we all have access to the same data. When there are economic reports, we all have access to the same economic reports. I can look at the jobs report. Wall Street Journal can look at the jobs report. Barron's can look at the jobs report. And if you say, well, I said the same thing as someone else, it's because, well, we're looking at the same data set. It would be hard to me to say, hey, 300,000 jobs were created when the data set says 150, right? So maybe that's what you're getting at. If it's in terms of opinion, well, I do read. I have a subscription for Barron's. I have a subscription for Wall Street Journal. I do read it. Unfortunately, I don't find that much interesting in it. Like, I scan it every day, and I might read one or two articles. I don't know why I pay so much for it when I only look at one or two articles. But it's Barron's tends more towards an interpretation of what they're reading. Wall Street Journal, I find, just is more factual. I don't know that it does much. I don't know. Sometimes, though, you come across a news story and you go, oh, I didn't know this. That's interesting. And that's why you have to keep your eye on the news, because this is where you get your information from sometimes, because you can't be looking at everything. So it could be. I'm not going to say no. It could be. What I have seen with Barron's, though, this is interesting, is I'll talk about something in my market outlook on Sunday, and throughout the week I do see stories relating to some of the things I talked about. So I don't know if somebody from Barron's watches what I do, or if we're all just looking at the same data and we're all coming to the same conclusion and we're just writing it or saying it at different times. Writing a paper on oil booms busts affecting Alberta from a demographic and economic view. Energy sector study and applied level, highly useful. Gave me a good idea of what indicators I should look at. Made me wonder if the boom in 2008 would show greater effects on employment, wage rates, and immigration than the peak prices in 2009 to 14 due to greater use of EOR, which uses more technology rather than labor. Well, in 2000 to 2008, during that period of time, the oil sands really weren't built to the level they are today. Massive investment was coming in and building out the wells. It was not as built up as it is, when you get to 2014. That's the result of a lot of investment. So much investment was coming in that the Canadian dollar was trading to a premium to the US, not a discount, but a premium. Went to $1.10. So 1 Canadian dollar bought $1.10 US. Right now, 1 Canadian dollar, I think, buys 72 cents, 71 cents US. So big difference. And when you're first drilling the wells, you don't need EOR simply because, well, it's a different process in the oil sands. You're taking all of the tar sands, and you're heating it up and melting out the oil. So it's slightly different. I think the big difference between the effect on employment was between 2000 and 2008, not only did you have oil field workers, you had infrastructure workers because you had to build everything. After that, you didn't need infrastructure workers, you just needed oil field workers, right? What price would you be allocating in DHI again? I don't know. Saw it took a tumble on Tuesday, yeah. They had an incredible run. An incredible run to the point where, I felt that quite a bit was already priced in. I don't know where I'd be picking them up again. I sort of just have drifted away from them. The other side of the trade that scares me is, what if central bank monetizes the debt? Let them. And that causes inflation, which sends TLT trade spiraling lower. No, if the central bank is going to step in, they're going to step in at particular parts of the yield curve. If the central bank is buying, if they're a buyer, there'll be a rally in bond prices because you have a price insensitive buyer. So the bonds will just be bought up, knowing that the Fed is going to step into the market and pay whatever price happens to be going on at that time. So, hang on. Yeah, go ahead. I got somebody coming in the door behind me, making all kinds of noise. You hear them? Not even caring what I'm doing over here. Blah, blah, blah. Anyways. Yeah, so if the central bank did say we're going to engage in quantitative easing, I don't know that where on the curve they buy is going to be as important as the fact that they are buying. Elaborate more on the correlation between U.S. deficit and its growth. If U.S. government spending is to foreign countries and not to domestic market, then can we conclude that the deficits bought the growth in U.S. GDP? Well, you got a point there. If they're taking that money and they're sending it to other countries altogether, probably not. They're loath to do that. It is difficult to get that done politically. They usually there is some restriction as to where it can be spent. Usually some restriction. So if they were going to buy military gear, they would more than likely favor American suppliers of it. If you look at GDP, the G component doesn't equal all of GDP. How is it possible that the deficit is buying all of the nominal growth? You have to think about how the deficit is formed. It's not always just spending. Sometimes it's a tax credit. It's where I'll give you $7,500 if you buy an EV. So you pay $7,500 less, but somebody gets that $7,500, right? Or it could be that you get some deduction on your taxes if you do something. So that means that you don't pay what you should have paid anyways. Hence, it is a transfer to you. It's just that no check was involved. And then you go spend that savings somewhere else. And you think, well, the government didn't spend it, I spent it. So that transfer payment shows up in the C component, right? Let me draw that out just so that you can truly see that. If we're looking at real GDP, you have C plus I plus G plus X minus M, right? And you can make the argument that the G component never equaled all of GDP. The C has a fairly large component. But G is government spending. We'll just call that government consumption minus taxes, and we'll just put the T, or T minus T. Well, you get what I'm doing. Let's say it's the absolute value of that, and that is their spending. Well, if they give you a tax credit of, let's say, $5,000 to do something, that means you're not paying $5,000 to the government. That means this is $5,000 lower, so their deficit is higher, but it's not government spending, it's consumption spending because you got to keep the $5,000 and spent it somewhere else. So some of the government deficit spending, some of it is government spending itself, and some of it shows up in the C component because you didn't pay the $5,000 you should have paid because the government gave you something. So you have to look at the deficit as a percentage of GDP. Let's say it's 6%. That's a nominal deficit. And if nominal GDP was 6%, that means the government completely bought all the growth. Not all of the GDP, but all of the growth in nominal GDP was paid for by the government. And the point that I was making is in going back to 2017, 2016, something like it was it 4 or 5 of those years were completely paid for with government deficits. So they're outside of government deficit. If you had balanced budgets, you'd have almost a no growth situation. What happens if the U.S. moves to balanced budget state? The private sector picks up inadequate growth and Fed doesn't have to cut rates. Would your TLT argument be invalid? If you move to a balanced budget, you're taking money out of the system. If you move to a balanced budget, you don't have to issue as many bonds. You have bond funds. You have banks that have to hold bonds. You have insurance companies that hold bonds. You have pension funds that hold bonds. You have bond funds that have no choice but to hold bonds. And if you don't have deficit spending, you have a reduction in the supply of bonds. These all have to hold bonds anyways. It would push bond prices up because there'd be fewer of them. Also, any savings from one side is a loss of revenue from another side. So let's say that I decide I'm going to cut my own lawn. I save $40. That's all it costs me. That's why I have somebody do it. I save $40, but the lawn guy over here loses $40, right? So my savings is a loss of somebody else's revenue. You move to a balanced budget, you take $1.8 trillion out of the system. That $1.8 trillion is somebody else's income. That's somebody else's line item on their income statement. So you'd remove that from the system. So how are you going to get growth? You can't move to a balanced budget by cutting taxes. You got to move to a balanced budget by cutting expenses when you have a deficit. If you had a surplus, you move to a balanced budget by cutting taxes. So you got to cut expenses, which means you got to cut revenues by 1.88 trillion for other entities in the economy. So I don't know how you're going to get adequate growth. You would get a significant drop in consumption inflation, in inflation, demand-driven inflation, because it's 1.8 trillion gone. You would, if that did happen, you would have a zero line. Your Fed would drop because you're going to have anemic growth and you're going to have probably the specter of deflation. You'd move there even faster. Which is the problem. How do you move to a balanced budget without hurting the economy? How do you get there at this point? We have fiscally painted ourselves into a corner. It's a difficult way out. And that's part of my thesis of why the Fed has to go to the zero line, because fiscally it's hard to get out of this corner. But you got to get out of it somehow. The Fed's going to have to do most of the heavy lifting. What's your comment on agency's recent drop? The share issuance, right? They have standing at the market agreements with, I think, almost every major bank. And was it 2 days ago? Yesterday, they announced that they did sell some shares. I think it was $1 billion, and they have another $2 billion. So they're selling shares. And since their book value is lower than $9, it's like upper $8. Those shares are being sold at a lower price because it's not a secondary offering, it's an at the market offering. They're probably being that you have that many more shares, they're probably being sold at a lower price. More than likely, the drop in price was the news of the now they had this at the market offering for some time. This was known news. It was the size of the offering that was new. So it was probably because, whoa, that's a lot more than we thought, and that's why it took a drop. I saw it drop 30 cents, and that's a big move for agency. So I went looking, and it was an 8K filing. 2 topics: U.S. election outcome, betting markets showing huge Trump lead, something of the order of almost 30-point lead over Harris. Oh, careful! That's not what betting markets show. Betting markets don't show the the weight of popular opinion in terms of the lead out there. That's not what it shows. Meanwhile, political polling shows them neck and neck. Where do you think the disconnect is? It's not a disconnect. Let's say that, how can I explain this? Here's a good way to explain it. Let's say that I have a coin, and it's an unfair coin, heads versus tails. It's 60. It's weighted so that 60% of the time it'll land on heads, 40% of the time it'll land on tails. And this is widely known. And I open up a betting book. Well, most people will bet on heads because it's that it has a 60-40 advantage. So most people will vote on heads. The book will almost line up to 100% on the bet because that's the smart bet, right? That does not mean that there's a 100% probability of getting a heads. It just means that if you flip a coin, you're more likely going to get a head, right? So let's say that there are two people in a race, and they're neck and neck, but person A, person B, and there's the finish line. At some point, the market believed that person A was going to win, but person A was going to win by 0.1 second. The weight of the bets would be on person A, right? The high probability would be on A to win, but A's just going to barely squeak by. That if you looked at it in terms of by what percentage is he going to beat the other person by, it would be infinitesimally small. But as soon as you feel that that's still going to be the winner, you're still going to bet on the winner. So a betting book is not the same as a poll. So that's not what the betting books are saying. The betting books are saying it looks like Trump is going to win, but Trump doesn't have to win by 60% or 70%. He only has to win by 1%. And if you knew that he was going to win by 1%, what would you bet on, right? So the betting books are different. Jamie Dimon, speaking at American Bankers Association, I think inflation might tick up again like 2016, like it did in the 70s. He was wrong last year. Largest peacetime deficit ever at $2 trillion. Yeah. Do you see this as a path to lower Fed funds rate in the long term, or do you think this is unlikely? I know when you look at granular inflation data, you mentioned almost everything, if not everything, that can be affected by high rates has already been brought down to the 2% target. That's true, and even lower. And with oil taking a big dump this week, that is deflationary as well because energy is an input to almost everything. Why do you think he believes this trend will reverse? Well, I mean, he's one guy with an opinion, right? It's not my opinion. You might say, yeah, but look who he is, and look at the information he has in front of him. He runs the biggest, baddest bank on the planet. Don't you think he knows something a little more than you? Sometimes the ties that bind are also the ties that blind. He sees the world through one particular lens, through a banker's lens. I see it more through an entrepreneurial lens. And from my vantage point, I see deflationary forces everywhere. From an economics perspective, if you increase supply, you put downward pressure on prices. So if you tell me the U.S. economy is adding jobs, big numbers of jobs, I would say the U.S. economy is adding supply. Because if I'm hiring a worker, that worker must be producing more than what it costs me to have them. Otherwise, why would I have them, right? I wouldn't be paying $100,000 for somebody to produce $50,000 worth of goods. That would be silly. So I must be paying $100,000 for somebody to produce something of value of more than $100,000. That is supply. They're producing something, so I'm adding supply to the market. So if you see employment going up, supply of whatever they're doing must be going up as well. That is deflationary. That puts downward pressure on prices. And that's what I'm seeing right now. And I don't know if he looks at the world through those lenses. He looks at the world through a credit lens. So what's he concerned about? He's concerned about all the things that make credit more expensive. And you can make the argument that this is going to be inflationary. There is no fault in making that argument. $2 trillion of extra spending that we didn't have, that we're borrowing it from foreigners to get it spent, that's going to be inflationary. You can make that argument. But nothing ever happens in a vacuum in a complex system. So, reason why economists love ceteris paribus is because it's the only way to say something. That means that all things held constant, if I raise the price of something, I should lower the demand for it. That is holding all else constant. But in a complex system, you cannot hold all things constant because it's a violation of the complexity theory. It doesn't happen. But you can't say anything unless you do that. Keep in mind that that's all the statements being made. Oh, you have X going on, that is going to lead to Y. Holding all else constant. Holding the pace of technology constant. Holding investment into entrepreneurship constant. You have to put that in place. But is technology constant? No. Is the pace of entrepreneurship constant? No. So you can't say X leads to Y, because if you have X, X will create something else. Something else somewhere has to give. You don't have everything that is held constant. If you raise the price of something, you get innovation. So one of the thinkings about regulation and why regulation is important is regulation sometimes isn't meant to slow down the economy. It is meant to induce innovation. So if I want clean water, the water's dirty. Yeah, water's dirty here, water's dirty here, water's dirty here. I want clean water. I can't just say, here is some investment money, companies. You come and get this investment money and create something to make this water clean. I can do that. Why is that not better than regulation? Why regulate and raise costs when I can simply just say, as the EPA, I want clean water. I'm going to invest $1 million and $2 million and $3 million in startups that have great ideas to clean the water. I can do that. Or I can say, you know what, I'm going to raise the costs for everybody that are polluting, and these people will now be motivated to lower the cost, and they will then invest their own money in innovation to lower that cost or to get around that cost. There are two ways that you can do it. And this form of regulation, actually, based on the research I did in my PhD days, these increases in regulations do increase the amount of innovation that go into that space. So it does, some regulations do have a benefit in inducing that. Maybe he's not seeing the world that way, right? He might not be looking at it that way, whereas a venture capitalist might see that. A venture capitalist might have a very different attitude about how that spending is going to play out. We all see the world in our own experience. I can't see the world the way you see the world because I don't have your experience. So I see it in a particular way. He sees it in the way, in his world, he sees this. In my world, I don't. So to figure out, well, what's the most likely thing, you want to try to get the view of as many people from as many different worlds as possible. That's the, if you do any kind of study on the philosophy of knowledge, you will come across the story of the blind man and the elephant, right? You have an elephant. I'll try to draw the elephant as best I can. It's been a long time since I've been in art school. There's your elephant. It's an angry elephant, so let's make it a happy elephant. There we go. There's a happy elephant with tusks. And one of them is over here, one of them is over here, one of them is over here, and one says, oh, it's a tree, and this one says, no, it's a rope, and each one has a different view of it. There are 6 blind men looking at it, but the combination of all of their views creates the whole. And this is what you have to do. Jamie Dimon is a banker. He sees the world through banker eyes. What does he have to say? Right? This person is an investor. They see the world through investor eyes. What do they have to say? This person is an entrepreneur. They see the world through entrepreneurial eyes. What do they have to say? Here's a tech investor. What do they have to say? And then you can get sort of a round picture from that. So it is important to listen to a whole bunch of voices. You can't dismiss any single one of them, but you can just sort of take it, for what it is, saying, well, it's the way you see the world. I want to start by saying I really enjoyed your videos and insights. Encourage us to read between the lines. Okay, I don't want to get into that. Your support seems to be primarily based on tax policy, evidenced by your comments on Canada's tax system and your subsequent move to Costa Rica. It seems you cannot leave your personal bias at the table as you live vicariously through the life of a U.S. voter. Okay. The reason why you don't come out and say this directly is because you run the risk of alienating parts of your viewership. I've never been shy about saying things. Through all the woke bullshit, I had no problem calling it bullshit all the time, even when everyone else was afraid to say a single thing because that mob was relentless. It was not a movement of compassion. It was a movement of hate, sheer hate. I had no problem speaking out. No, I had no problem. I'm not worried about alienating. I'm more concerned about being authentic, and not pandering. So you always see the world through, like I just said, it was a nice segue. You see the world through your own eyes. Let's say you had two people, and they have to vote for a person. And this person says, I'm going to raise taxes. And you have one very successful person and one not so successful person. This successful person will say, well, that's not in my best interest. I don't like that. And this person says, I love that. And then we'll say, oh, you're just saying that because you have money. And I say, yeah, but you're just voting for him because you don't. we all see the world from where we stand. To suggest that we are biased is to say, well, then you should not see the world from where you stand. And what is called bias, I think that word is misused a lot of times. It could be called informed. Well, I have it. I'm in a much more informed position because I have something. Or because I'm in this position, I'm informed, and I can tell you that's a stupid policy. Whereas you don't have it, you're uninformed, you don't know. I could say, if you raise taxes on me, that means that these investments that I would have made, I'm not going to make. And you say, yeah, but I'm going to get free stuff. You're not seeing what I can see. I'm not biased, I'm informed. I can make an opinion that is informed, where I have a look or a view on the world and information about the world that you don't, but from your perspective, I look biased because you can only see the world from your point of view, from your experience. And if you don't have the experience to see what I can see, or you've never seen what I've seen, then I appear biased, but you appear biased to me. Let's throw the word bias out. And let's just say we are differently informed, right? If I said, if you jump off that building, you'll plummet to the ground because I know something about gravity, and you know nothing about gravity, would you say, oh, you're just biased because you fell off the building once? It's like, no, I just have better information than you. I just have better information. So it could just be that I have better information or I have different information. And it has nothing to do with bias. Let's try to keep that word out of it. No commentary on Tesla. I'm trying to leave all the comments about my positions in the positions video, which is in the applied level in portfolio construction. I used to put them in the market outlook. I used to talk about all my positions, but then I put it in the applied level. And since this is a paid level, you have to, buy the applied level. This is where I put my positions. And a couple of people have pointed out that, hey, listen, if you have this behind a paywall, don't, you're dumping it out on YouTube for free. Try to keep your discussion of this stuff behind it. This is what we paid for. We paid for access to this. If you're just going to give it away for free, then give me my money back. And they got a point. So, oh no, I had comments on Tesla. And they are in, if you want them, they are in the portfolio construction module. I leave the comments on positions there. Tariffs versus broad consumption tax. I think economists are more supportive of broad consumption tax because they are less distortionary. They are agnostic between imported and exported goods, so you would lose some efficiency if you raise prices on imported goods. Big rule in econ is don't distort prices, transfer incomes. I first of all will agree that governments need to raise revenue. I disagree with governments going back to that same group of people every time and saying a little bit more, little bit more, little bit more, fair share, little bit more. If you're going to have a tax because you had all of the spending, everyone benefited from the spending. I didn't benefit from the spending, but I got to pay for it. I think a broad-based tax makes sense, and I think the consumption tax makes the most sense because I spend more, I will pay more tax. But it's a fair tax because you also pay the same percentage I do. I agree with that. So I agree that some kind of consumption tax makes the most sense. I would love to see that. I'd have no problem if Canada went to 20%. Instead of coming back after successful people again and again and again saying you need to pay more, you're a tax cheat, you're this, you're that. Stop demonizing them. They're heroes of the economy, really, if you think about it. They're the ones who run all the businesses that employ everyone. Give them a break. I was just trying to get to the to say, look, you can get through to tariffs by taking a back door. By saying, well, what if you start with a consumption tax and you had carve-outs for people with low income by saying, let's not tax housing, let's not tax food, let's not tax utilities. And then you could take it one step further saying, well, let's not punish our own people who are working and building things. Let's just tax the foreign stuff, right? You can get to the same result of tariffs by going through a consumption tax and just making the consumption tax less restrictive. But it does distort prices. I will agree with that. But a central bank buying bonds distorts prices. A government who wants to give a $25,000 tax credit to first-time home buyers distorts prices. A government offering $7,500 incentive if you buy an EV distorts prices. We already have massive price distortion going on. The government has distorted prices almost everywhere. In Canada, you get big checks if you have children. That distorts the price of having children, of making the decision to have children. That distorts prices as well. So you already have massive price distortion everywhere anyways. Why suddenly get religion when it comes to taxes, right? You previously made the point tariffs would lead America to lower value tasks, citing examples that would be silly for cut your own lawns and importing someone else. Have you softened your stance on that, or you just think there are some other positive spillovers? No, I seem to think that the U.S. has a trade deficit, but I seem to think the trade deficit is probably optimal. American businesses are precise in what they do, some of the most efficient in the world. They don't make stupid decisions or inefficient decisions. That they are making efficient decisions. It is an efficient allocation of resources to say, listen, we need to produce a product. So what we're going to do in this country is we're going to put all of our R&D staff over here, and why don't we just have all of our manufacturing made over here? This is all the high value stuff. This is really low value stuff. Let's do that. And we'll just import that, thereby making it look like there's a deficit. However, if they did manufacturing over here, they may find that they can't afford all of the R&D because the cost went up. So maybe they have to get R&D done in other parts of the world and import high value stuff instead of the low value stuff. Yeah, the deficit may be optimal. I think the side that I was taking is you got to pay for all of this debt somewhere. You got to pay for it somewhere. And I'm against going after the same group of people again and again. I'm against that, mostly because I'm in that group of people. But at some point, at 53.5% of your income, and a disproportionate amount of value-added tax. On some things, it's 33% tax, not 13% tax. If you're successful enough, you get to pay the 33% tax. You drive that capital away. And it hurts the economy in the long term that if you're going to institute a tax, it should be everybody in relation to what they spend. A consumption tax makes sense. So if you were going to put a tax on to start paying for this stuff, a tariff, well, it's better than going after that same group of small people. Now, much like regulation, if there's a tariff that raises the price of something, entrepreneurship will come along and say, I think I have a way around it. I think we can use more technology instead of labor to reduce the cost of that. You may actually get a wave of innovation out of that, because in a complex system, you don't just change one variable without changing the others. It's not ceteris paribus here in the real world. Institute tariffs. Oh, this stuff is more expensive. I used to get my stuff from this place. Now I go to that place. But if I invest in this piece of equipment, I can get my supplies from over here and I can make it on site cheaper than what I could buying domestically from other people. Maybe you get that wave of innovation, right? How does TLT determine its dividend? Well, it has coupon income and it maintains a duration, which means it is always bringing in new bonds and moving older bonds out, right? So it has to buy new bonds and sell bonds, and it maintains duration doing it that way. I don't know if it uses derivatives. I don't think so. I don't think it uses futures to maintain its duration. I don't think it does that. Also, does TLT price correspond to the same blended yields at all time? Pretty close, yeah. Assume TLT is 93 when the blended yield TLT is 4.5. Do you expect TLT to always be at that price even a few years from now, assuming the blended yield is 4.5? Oh, well, no. No. If TLT is holding a $1,000 bond that yields 4.5%, and it has 1,000 shares, each share will be $1. If TLT is holding $2,000 worth of bonds at 4.5 with 1,000 shares, each share will be $2. The yield doesn't have anything to do with it. It's the number of shares. It's the value of the portfolio divided by the number of shares. And because it's an ETF, you have creation and redemption baskets, right? So that when, let's say that this is the fair value of the bonds, and let's say TLT is moving like this, and it gets too far above its fair value, you will have the authorized participants engaging in arbitrage, because there's always a creation and redemption basket. So you will get either buying of the bonds and delivering to get shares and sell the shares. In this case, TLT is overvalued, so I, as an authorized participant, will go to the sponsor and say, here are the bonds, and that would go into the creation basket. I would get shares of TLT, of which I would then sell, which would force the price back down towards its net asset value, and that's how it stays within its net asset value all the time. So it has to do with the value of the bonds it holds divided by the number of shares, not the yield. Go a bit deeper on the pass-through to all rates if the short end is lowered. Well, it's just an empirical observation, right? You can search for a theory, because sometimes you have an empirical observation that needs a theory. And sometimes you have a theory about something in which we have no empirical observation for. So that happens mostly in physics. So Einstein had a whole bunch of theories, and you had some theories, but you couldn't prove any. You had to go out and find empirical observations to get that done. That's experimental physics, right? In the real world, you have, more often than not, you have empirical observations, and then you go looking for theories. So the pass-through from the short end to the long end is an empirical observation. What's your theory for it? I don't know. There are lots of competing theories. You can pick whatever one you like, but it is just an empirical regularity in the data. If I were to purchase a REIT, 30K cash, 70K margin. Margin is you. So you mean 30,000 cash, 70,000 margin loan. Can one view it as similar to purchasing a portfolio of diversified physical properties with mortgage financing loan to value of 70%? No, that's more than 70%. Right? You only use 30,000 in cash, and you're using, and you want $100,000 worth of stock. That's 3-to-1 leverage. So no, I wouldn't see it. I wouldn't see it that way. Oh, hang on. You're asking if it's equivalent to having bought a home, $100,000 home, let's say, by putting $30,000 down in terms of the leverage. Yeah, it would be equivalent to that. But your margin interest will not be a mortgage rate. So its cost would be excessive. Yeah. But as far as being equivalent, sure. On a statement of the amount of leverage you have, sure, but its cost would not be the same. And it wouldn't be the same for operationally it would be challenging. A property probably wouldn't be called away from you. Plus, with the property, you're making mortgage payments, so you're always paying down that loan. So to make it look like the same thing, you would want to pay off the margin loan the same way you would a mortgage. When you mentioned in your last videos you're holding cash and earning yield, how does that work on IBKR? They just give you money. If you're holding cash, you get paid interest on it. You're leaving cash in the money market, you don't have to. Yeah, IBKR pays interest on uninvested cash. Yep, by default. Yep. Over a certain amount. I don't know what the amount is. Like under a certain amount, you don't get anything. Significant property appreciation in Dubai in the last couple of years. No kidding. Due to the inflow of wealthy expats, do you expect to see a similar trend in Costa Rica if you haven't already to the same extent? It won't be to the same extent at all. Dubai is very developed. Costa Rica is not. Dubai has a fairly tight rule of law, even though it's dynamic. It does change, and you're expected to know it. It does have a rule of law and a very strict rule of law. So it's one of the things that people will tell you in Dubai is it's an extremely safe country, extremely safe. That you can leave your things in your vehicle with the doors unlocked and no one's going to touch it, only because the penalties are so severe. Not in Costa Rica. In Costa Rica, I would say that theft is almost institutionalized. It's everywhere. If you go to a restaurant, go to 10 restaurants, I guarantee you 6 of them, at a minimum, will put things on your bill you never ordered. And you'll point it out and they'll go, oh, mistake. But they make that same mistake 50 times a night. It's institutionalized. It's everywhere you go. In Dubai, that's you're stealing from somebody. The penalties are brutal, right? And something to be said for the rule of law if you want to, the social contract, if you want to live in a safe society. How much of your freedom of expression are you willing to give up? Right? The penalties are severe, not so much in Costa Rica, and I think that's a problem, is the lack of development in the infrastructure, the amount of institutionalized kind of theft like that. It is very cultural, like it permeates the culture, and just the corruption in politics. If you're an elected official, you're more than likely living in really, really expensive house that your salary clearly does not afford. And well, that's it. It's not the same. So I wouldn't expect to see the same thing happen there as you would in Dubai. Dubai really is a first world city. Costa Rica is a third world country. And just because of the way it's structured, I don't see how it can escape that third world trap. Would you ever consider investing in properties and running Airbnbs? No, no, I would not. I Airbnb mine now just because I have it and I'm not there, so I may as well. But the cap rate on Airbnb is extremely low. You need to be in areas where you have the potential for 70-80% occupancy. Now, Airbnb gives you a ranking of all the cities and the average occupancy in these cities. Costa Rica, even though it's a vacation place, San Jose is running around 33%. On average, 33%. The better your place is, the more you can approach 45, 50%. But you can't make money on a property at 50% occupancy. You have to start getting 70 to 80% occupancy for it to be worth it. But to go into those places, the price that you pay for the property is significantly higher, so you end up with very low cap rates. Airbnb is great when you have extra capacity in real estate where you say, well, I'm not doing anything with it anyways. But as a business model, I don't see it. Not as a business model. Yeah, and it's getting tougher and tougher to do. In some cities don't even want it. Some cities require you to pay a license for each place that you have that makes it onerous to even make money after that. And then there's the whole tax situation on the property itself. When you sell the property, there are tax implications because it was no longer a residential category, it was commercial. It's a tough game to play. I wouldn't do it. I do it because I have a second property. I own it by default. So why leave it empty when I'm not there? Why not get some cash flow out of it? But as far as a motivating investment, no, not at all. You never mention exposure to alternative asset classes. Oh, I do have that. I'm sure it's something that you have considering asset. Oh no, I do. I do have exposure to it. Would I be right to conclude a volatility smile is a bullish signal? Typically it is. Yes, it is. Would you agree that lags matter more on the way up than on the way down? In the sense that when rates go up, companies with swaps or long-term debt can wait until the swaps or the bonds mature to feel the higher rates. True. But on the way down, companies could borrow cheap immediately to pay down their more expensive debt. No. It's not that simple. A company issues 10-year bonds. And they're typically, with corporate bonds, they're typically, after a short period of time, they're typically owned by buy and hold funds. Many corporate bonds have no liquidity. So you borrow at a lower rate, you go to buy back your other bonds in the market, they're not for sale. You have to pay a premium to induce that other side to sell it to you. And the other side's going to say, well, I'm getting a nice high yield. If you give me my money back, I can only get a lower yield. So you're going to have to give me a lot back to make me indifferent, in which case you're already paying for it. So it's difficult to say that you can, when rates go down, that you can just automatically renegotiate your debt. A lot of that debt is locked in place and there's really not much you can do unless it's callable. If it is callable, it'll be callable on certain dates at premiums. So it still will cost you, right? So, because if that wasn't in place, why would I ever lend money to you at 6%, knowing that you're only going to pay me back when I can reinvest at 3%? I'll never really ever get to enjoy that 6%. In which case, why don't I just invest in a money market fund and get whatever the money market is paying? I'll get rates on the way up and rates on the way down, because if you can buy back the debt at any time, am I not getting a floating rate of interest? Right? So it's not that straightforward. Isolating variables to come up with an idea about future within a complex system as being essentially futile, and how we are unlikely seeing a dramatic downward price action in markets unless there's some exogenous event. I think that's true for if you are waiting for some significant downside to the S&P, like 15-20%, you need a catalyst. What's that going to be? Don't look for the weight of the market on itself. Don't look for overvaluation. There's usually, if you look at all the big pullbacks, more than 20% in the S&P, there was always some catalyst, some exogenous event that caused it. It doesn't just happen under the weight of itself. It could be an endogenous event, like we wake up one morning and some company, some significant tech company has reported that this AI stuff is all bullshit, that it doesn't work, or that some company comes out and the SEC says they're under investigation, they're going to have to restate the last 3 years of their financials for something, and so is this company. And it's like, oh my God, accounting scandals all over again, like we had in 2000, 2001. Enron, Adelphia, WorldCom, all of those. It could be something endogenous like that, but there has to be a catalyst. You're waiting for a 20% downturn, I would say, what's the catalyst? What gets us there, right? Comment on how often talked about recession metrics. Might be related, work together. 3-month tenure and 2-year tenure and quarterly GDP. 3-month tenure still inverted. 2-year tenure inversion occurred over 27 months ago, but the NBR standards, we have not been in a recession. GDP continues to print quite positively. Well, because the NBR doesn't look for a curve inversion and say, we're in a recession. It looks for a broad-based decline in GDP for that lasts for 2 quarters. Doesn't necessarily have to be negative GDP, just a broad-based decline in GDP over 2 quarters. Haven't had that. Who cares about the inversion? Now, the inversion usually leads to some weakening in the economy. The 2 to the 10 reallocates capital. It will bring a strong economy into a weak economy. And the 3-month to the 10-year, usually if you have something happen in a week, that usually happens in a weaker state, that's usually what takes it down. That didn't happen this time. And if we need to point to something, as I've shown in the last market outlook, it is the amount of government deficits that have basically kept nominal GDP above zero. Get a balanced budget. The U.S. has been in a recession for 3 years, 4 years. If you have a balanced budget, 5 years, 6 years, the U.S. has been in a recession. Really, so multiple recessions. They would dip into recession, come back out, dip into recession, come back out. It's the deficits that have kept the U.S. from a recession. Okay. I have a pretty macro sectoral balance approach. Everyone is playing now the inflation scare game, pricing in a slower cut or even a complete stop. Yep. I'd say the IR cuts are already starting to reduce fiscal support. Private sector. Amount is not much yet, and it's masked by other leading fiscal transfers that are still strong. COLA will also be much lower next year. For those who don't know, COLA is cost of living adjustment. And that is another significant cut. Balancing the budget is a horrible idea. Well, balancing the budget is a necessary evil. It must be done. It is medicine that has to be taken. If we're talking about for the health of the economy, balancing the budget is going to kill the economy. I want you to think about the situation that we're in where we cannot balance the budget. We must continually spend more money than we take in tax revenue. Otherwise, it's going to kill the country. That's like saying, I cannot stop spending on my credit card. If I do, I'm in trouble. Well, then you're in trouble already. The credit card is just masking the problem. You're already in trouble. So the economy's already in trouble. The deficit's just masking it. Every single time it's been tried, it has been followed by deep recessions and depressions. Well, then we must then say there must be something with capitalism that's broken if it requires that much government spending to stay afloat. But I don't think that's true. That a balanced budget has resulted. That it was the balanced budget that has resulted in that. Private sector can tolerate a reduction in fiscal support for a while if it's willing to accept credit, but at some point the credit, being income constrained, will very likely end with a crush. Well, if you are saying that the economy only works with increasing debt, then the economy doesn't work. Underneath, it simply doesn't work, right? It's like me paying for my son's apartment and his vehicle, but still telling my friends, "Oh, he's doing very well. He's living on his own now." That's not true. I mean, he's not really, right? That as soon as I stop paying for things, he will be homeless on the street and drug addicted. That I'm the only thing that's keeping that from happening. Then I don't have a healthy, a growing son. I have a dependency. It's not working. Super impressed by your fitness journey. Looking to drop a stone or two since I consider you my. Why not pick on health as well? How many calories do you consume a day? I don't know. I don't count the calories. The calories I consume per day are from low glycemic foods. So if you want to make a big difference in your diet right away, don't start thinking about calorie restriction. Think about just changing what you get your calories from. Just Google glycemic index and you'll get a whole bunch of charts up about what's on high, what's on medium, what's on low glycemic. And look at everything on the high glycemic index and just say, okay, you're gone. All of this stuff is gone, and see if you can't substitute it with something on the medium or the low. Just that alone will do wonders. And then over time, see if you can't shift everything from the mid glycemic index to the low glycemic index, right? And then restrict your eating time. So instead of saying, well, I'm going to eat at 9 in the morning and stop eating at 7 at night, maybe say, I'm not going to eat till noon and I'm going to stop eating at 8. Like slowly restrict the window in which you eat. Low glycemic food and restrict the window in which you eat. That's all I did. That was it. Huge difference. I'm under 220 now. I didn't think I'd ever get there. You mentioned cucumber, tomato, cauliflower for Sunday meal. Yeah, pretty much. Pretty much every meal. Are you consuming any protein or meat? I do, yeah. Because none of that spikes your insulin. How about bread, pasta, rice? No, got to get rid of that. How often do you work out? Every day. How much? Is it cardio or weights? Mostly weights. Because of my knee, cardio has become challenging to do. So I don't want to accelerate the problem with my knee. I want to stretch I have one knee that's a problem. The kneecap wants to keep popping sideways. So I want to stretch out the life of my knee, so I'm trying to take it easy on that. How about health tests? Don't do any. I don't know if it's true, like a lot of diet noise, but heard Atkins increases risk of arteriosclerosis. That's coming from another diet group that says, oh, don't do that, you'll get this. And this group says, oh, but if you do that, you'll get cancer. And another one says, yeah, but look at his candidate. I don't know. Sclerosis. I imagine that if you, I can see how it could lead there. But I mean, if you are careful in where you get a source of calcium from, I think you'll be okay. So broccoli, lots of broccoli. I mean, lots of calcium in there. I don't know. I haven't felt any issue. Now the thing is, you do this for a period of time. You don't have to do that for the rest of your life. You do this for a period of time until the weight comes down and until your body starts burning fat and not burning sugars, right? So you're switching. Usually, if you have like a high carb diet, your body will burn sugars all the time when you're exercising or when your body's consuming calories. It takes it from its sugar stores, glycemic stores. You want to turn your body into a fat burning body, which means if you think about insulin levels, right, you want to get your insulin levels down. And when your insulin levels are low, you become a fat burning machine, which is what you want to do. When you're doing that, you can introduce other things into your diet, and you're not gonna switch your body back to a sugar burning body. You'll still say a fat burning body, but you can still cheat every now and then, right? Federal deficit percent of GDP. Can you explain how this ties? Oh, already did that. In order to get a younger country and attempt to increase fertility rate, could it make sense to subsidize daycares as a benefit society? So this is a thorny issue. Is at what point are you responsible for your lifestyle choices versus the taxpayer being responsible for your lifestyle choices? The taxpayer already pays for your child's education up to grade 12. The taxpayer, in Canada at least, already pays for your child's health care. The taxpayer already pays for the government to send you checks every month because you have children. At what point are you responsible for your own lifestyle choice? Education up to grade 12, check. Health up to for their whole life, check. Checks every month that decrease with age, check. Got that. Now it's well, daycare. What about daycare? And if we do that, do we then have government drivers that pick up your kids after school and bring them to soccer practice and bring them home so you don't have to? What about changing your diaper? I mean, that takes a lot of time, changing the diaper of your babies. Well, why not have a government worker come over, 2-3 times a day to take care of that? Why not just have government nannies? Like, where does it end? Where does your responsibility for your lifestyle choices pick up and my responsibility to subsidize your lifestyle end? You can make the argument that all of these things are better for society, but I had a dog that I had to walk 4 hours a day. I couldn't produce content. Well, if I could have produced more content, I could have raised revenues. And since revenues came from outside the country, that was beneficial to society. Why wasn't there a government dog walker? Why don't busy people have government-sponsored dog walkers that come by and walk our dogs for us that the taxpayer pays the bill for? Right? Why not have that? Look, I'm a busy person. When I got to drive somewhere, I'm not producing content. Why is there not a government-sponsored chauffeur that picks me up and drives me where I want to go? That would benefit society. Just because something is a test, well, that would benefit society, the taxpayer should pay for it. Where do you draw the line on that one? When you already do a lot as it is, when a lot is already being done as it is, you decided to have a child. You realized how much of a sacrifice it was. You decided to have a second and a third. You've made your choice. Oh, boo-hoo-hoo. It takes a lot of your time. You should have thought about that. Sure, it benefits society, but a whole bunch of things benefit society that we don't pay for. That we say, well, look, this was your choice to do. I work out in a gym. I'm healthy. It keeps me healthy. That benefits society when you have free healthcare. Why doesn't the government pay for a gym membership for everybody in society? It would benefit society. Why doesn't everyone just have a free gym membership? Why doesn't the taxpayer pay for a gym membership for everybody? Right? Taking out high sugar foods out of the grocery store would benefit society. Why doesn't the government do that and restrict your choices when you go to the supermarket? I don't know that I would use it's a benefit for so many things are a benefit for society. Giving everybody $1 million would benefit society because you'd get rid of poverty overnight. Why don't we do that? Right? So it's once you start saying it benefits society, I find that that's not a strong enough argument to say, well, let's do this policy, because we can think of a whole bunch of things that benefit society, but why should the taxpayer pay for it? I can see if we were doing nothing for parents with kids. They're on their own. They got to pay for school. They got to pay for healthcare. They got to pay for everything. And we know we need a supply of younger people. Then we'd say, well, let's do something. But we're doing a lot. But it's not good enough. We're not helping them enough. It's not good enough. I'm still busy. I still need the taxpayer to pay for a significant part of my lifestyle choices. That's sort of what I'm getting at is like, look, I'm already doing all of this stuff. We're already doing this. Must we do everything? You're long TLT. Why not be long I 7 to 10? Yeah, it's just not enough duration for me. Diversification since shorter end of the curve. I don't want to diversify. Actually, I like the concentration I have in the duration, and I am diversified in duration to a degree because I'm long utilities, and that's a duration play. And utilities have held up quite well. So I am, to some degree, with duration diversified, just not diversified in specifically U.S. Treasuries. Aren't OAS and rates inverse proportional? You said everything is priced using the Treasury. Yep, why not high yield, see higher yield? They do. It is proportional. The OAS is a measure of credit risk. So let's say that you have an OAS on high yield on average. Let's say it's 500. This will be based off some Treasury rate plus 500. So the higher the Treasury rate, you add 500, the higher the all-in yield. So if the Treasury rate is 4%, right, that's a 9% bond. If this goes to 5%, this is a 10% bond. If this goes to 6%, this is an 11% bond. So everything is priced off this curve. It's not as if this will always stay 9% no matter what. It is priced off that curve. This is the base on which you add the spread. Everything's priced. Will not high HYG investors seek higher yield then as well if long end of the curve comes down? No, if long end of the curve comes down, they'll have to accept the lower yield. If it goes from 6% to 4%, it'll go from 11% to 9% if you keep the spread constant. Typically, as interest rates rise, now when we say there's an inverse relationship between credit spreads and Treasury yields, it is for demand-induced inflation. Once you have supply-induced inflation, all bets are off. But typically, as the economy improves, spreads tighten. As the economy improves, inflation heats up, so Treasury yields tend to rise because the Fed raises rates. So you get a rise in yields, but a contraction in OAS, which is basically what we've had for the last couple of years. When the economy's in trouble and it heads down, the Fed tends to lower rates when the economy is in trouble. But credit risk rises, so OASs tend to rise. It's not, you have to bring in the economy. That's the missing variable in the inverse relationship. It's not, well, if yields go down, OAS rises. The intervening variable is the economy. If rates go down because the economy is weak, OASs will increase. IBK, I want to buy 50,000 US stocks. What is the best way to convert my currency? Does IBKR automatically do it as spot? No, IBKR will create a negative US balance. You must first convert your currency and then go ahead and buy. Back end of the curve telling us domestic and foreign buying appetite of US government debt is low. People started to be concerned about US debt. Imagine if the Fed started buying all the long end of the curve and no domestic or foreign entities and people. What is the outcome? Outcome is Japan. And I do believe that that is where we're headed. How do you deal with the perverse nature of market discipline? Perverse nature of market discipline. Is it always perverse? The craft is quite different to other pursuits in that it can feel like you are punished severely for doing it. Oh, let me pull up a chair. If you want to talk about being punished, sometimes for doing the right thing, for doing everything correctly, pull up a chair. I've got stories to tell you. I understand it is important to be humble, but in seemingly ridiculous cases, like the worthless MicroStrategy, for example, we would be brutally punished for shorting it. True. Is it the case of choosing the right playing field? Look, I find that the market today is far more behavioral than it was like 10 years ago. Even 5 years ago, far more behavioral. You can point out the obvious and it won't matter. You can point out that, look, at where Bitcoin is right now, all those convertible bonds will convert to shares. You can point it out till the cows come home. No one will care because no one's looking at that. It's momentum. That's all it is. It's going up because it's gone up. So look at it. Look at it. It's gone up. It's going to go up. It's going to keep going up. And it's simple-minded thinking like that continues to push it up because they continue to buy it because the belief is it's only going to go higher. Because you got leverage. As long as you give them a story to rally around, they'll keep repeating the story. You can get crushed shorting that thing. But yeah, it doesn't belong there. It is the most ridiculous thing. You're paying about $200,000 per Bitcoin when you could buy it for $72,000, or you could buy it on margin, right? Get a margin loan, and now you've got double the amount of leverage, and you only spent $36,000 and you have it. Or use options, or use future. You can create your own, but it's momentum at this point. That's all it is. And when you have momentum, the fundamentals don't matter. They don't matter. All that matters is it went up, it's going to go up again. It's going to keep going up until it gets to such ridiculous levels. But this is where we are. I find that this market is far more behavioral now than it's ever been, which makes it rather difficult. The fundamentals do eventually show up. Much like the fundamentals for this thing will eventually show up. The pathway will kill you, though. But I do agree that you can do your homework, you can be spot on, you can be dead right and still lose money and lose big because a narrative gets a hold. This is my concern with TLT. I'll say this straight up. Somebody, I have been asked, what could go wrong with TLT? Fundamentally, I think I'm going to be right. But you get Paul Tudor Jones saying short. You get Druckenmiller saying short. You get a whole bunch of people jumping in on this. This will create the behavior that does push TLT down because it pushes bond prices down. And it pushes bond prices down because everyone says it should push bond prices down. So you get a large part of the market that's no longer thinking about it anymore. You get enough people repeating it. They start acting that way only because they're hearing it everywhere without really looking at the fundamentals of it. Now, the fundamentals will eventually show up, but man, the pain on the way there, right? Anybody in TLT right now has got to be, every day you wake up, you look at the screen, it's red, it's like, oh, come on. But today was nice. Today it dropped like another 80 cents, and then it just rallied into the end of the day. I think that was a good sign. Who knows? I don't know. But I think the fundamentals will eventually show up, and this is just a great opportunity for something like this. But you're right, MicroStrategy, Tesla these are cults, and they have a life of their own, and you have to play the shareholder, not the fundamentals. You have to play the shareholder. And if you are going to be long MicroStrategy, you can't be quiet about it. You got to get on TikTok and YouTube, and you got to put videos out there, and you got to say, this is going to the moon. This is your last chance. This is a 10-bagger. And you got to pump and pump and pump and pump that thing because the fundamentals are the shareholder, not the company. I mean, MicroStrategy is a value-destroying business on its own. It has a money-losing software business and no leverage in its Bitcoin holdings. It is fundamentally, mathematically not worth that price. Psychologically, it could be $1,000 by the end of the week. If you get enough people to believe that it could be $1,000, it'll get there. The issue should be in terms of relative performance. Drop in rates is good for TLT and even better for stocks. What scenario would long bonds outperform the Mag 7? I don't know. Long bonds outperform? I don't even know if you can. As long as the AI story stays alive, sorry about all the dinging, I don't know who's doing that to me. As long as the AI story stays alive, I think the Mag 7 will continue to do what it's doing. No, I don't. I don't know that long bonds would outperform. But you get a market downturn, Yeah, there's a condition. Let's say that you get a market downturn, you get some event, and stocks just head down. Money will go into treasuries. It will, and the long end will outperform. When you say you're looking for a good story, can you please elaborate a bit on what constitutes a good story and possibly give us a few tangible examples? Well, a good story is, I mean, I don't know that I could lay out, here's all the elements a good story should have. Um, it just should be positive for the future. In whatever, like AT&T, lots of debt, nice dividend yield. What's its story, right? It has an eye towards debt. It wants to bring its debt levels down. It is moving to Open RAN architecture, which means that it's not going to be tied to any one vendor. That will lower its costs. It's embracing software-driven networking as opposed to always looking for hardware. And for its infrastructure build-out, it's using BlackRock to make the big investments, and it's just being a client to the joint venture that BlackRock is funding, which means it can build out a lot of fiber without paying for it. That's a good story. And it's a network. A network's not going away. That's a good story for AT&T, right? Identifying good stories comes with experience. It does. Having said that, for us with much less experience, can we still identify good stories? Yeah, I think it would be a lot harder for you to recognize what a good story is. Even if you were told a good story, if you didn't understand the sector, you might not recognize it as a good story. Or you may hear a story and fail to recognize that that's not a good story, it's fantasy. All right, some companies just have fantasy. Like a car company saying it can increase sales in a competitive space by 20 to 30% next year. That's fantasy. But it's a story. You gotta, if you don't have good numbers to give out, if you don't have good numbers, you better have a good story. Public debt of many Western countries, could it be argued that the issue isn't as significant as it seems? Could selling off real estate or privatizing public companies effectively mitigate this debt? That's a lot to sell. But yeah, selling assets have been done by governments before. But the question comes to this. If you're going to sell your assets, are you actually going to pay down the debt and not just reissue that debt 6 months later? Because if you are, all you've done is lost an asset. That if you're going to sell the assets, it should be to pay down the debt, period. And when you pay down the debt, to make it even more serious, you should lower the debt ceiling. So, for example, when people have credit card debt, part of paying down the debt, if they go to a credit counselor, part of paying down the debt is also reducing the amount of credit you have on your credit card. So you refinance, you go to the bank, you get a refinancing loan, you pay down all your debt. The bank will typically request or require, as part of that renegotiation, that your credit card credit limits get lowered significantly. So you would have to do that with government. Otherwise, you're just selling off assets only to get back into the same problem. So if I, as your father, say, okay, I'll pay off your credit card. You have $5,000, I'll pay it off. What good is that if you're only going to run out there and say, yay, I got $5,000 I can spend now? You're just going to be right back in that same problem again. That if I pay off your credit card, I want it. Give it to me. Give it to me. It's mine. You lose your credit card. I'll pay it off for you, but you don't have it anymore. Right? Don't know that governments have the discipline given the election cycle and given what democracy is today, given that you have to give stuff away to get elected. One party that gets elected to do the right thing could be undone by the next party coming in who promises, oh, it won't be like that. We'll reinstate this payment. We'll reinstate those benefits. This is because you got to get elected, right? Hard to get that done. without the private equity model of what I started this with, is you need to be outside of the voting system for a while to be able to do the tough stuff. Market occurrences, how much track record do you put any probability of history not repeating itself? Well, you always have to think that this time could be different, but those, you've heard that expression before, the most dangerous words in the market are "this time is different." How long are you planning to do the weekly market outlook videos? Well, at this point, I can't answer that because I have no plans. I have no plans to stop it. I mean, it's not like I'm thinking, I'm pretty much done this. I'm not there. I don't know how long, but no date on the horizon yet. What are your thoughts on Pierre Poilievre? Well, I mean, you're looking at him in comparison to what we have with Trudeau. So he is a savior. You got to see him as a savior. He just seems to have, he's the guy with common sense. And you could say that only because the other guy has no common sense. He's pretty much a doofus. But if you had him up against a more significant liberal leader from the past, I don't know. I don't know. Just, from where we are now, it's one or the other. Assessment TLT, kind of annoyed by the latest round of FUD being tossed around CNBC like Paul Tudor Jones. Suddenly the deficit matters. It's scary. Either they've been living under a rock for the last 5 years or they're purposely playing the market to get some cheap TLT. I think if you have a position and you're big, no point keeping it quiet. At this point, you want everybody to know, and especially if you have a name, because that may actually help generate the return you're trying to get. I agree. I wish I were bigger. I wish I had an audience of 5 million people. I would be super. I wouldn't just be wealthy. I'd be super rich if I had that many people. And especially, I got people who listen because, I have a particular view on the world that is informative. But if I didn't have people who listened, I had followers. That's what you want. You want followers, and you want millions of followers, because followers will just do what you say. Followers will just you say, I'm buying this, and they'll do it. I mean, crypto is full of that kind of stuff where I'm introducing this coin and this and all of their fans buy into this, and it's all just a money transfer mechanism from the person saying it to they just fleece their own followers, which I think is rather disgusting. But I think if I were big and significant and I had a name, I would say that is my alpha. That is my alpha, is that I can create the return that nobody else can because I'm going to go on TV and say this stuff. That's my alpha. I may as well use it. Suggestion for your live market Q&A. YouTube has a setting called slow mode that throttles viewers from rapid posting questions and hogging your time. Yeah, I know I can slow them down. I know that. I just haven't done that. Do you donate to chair? Already answered that on the live. Comment on Oxy. I will do that on Friday going into for the positions, because I do have a position on Oxy. I'm going to keep my positions in the positions video. Deficit is larger than GDP growth, so a decrease in spending the balance of the budget would likely a year of negative growth. Years, not just a year. Government spending declined 21, 22, 23. Government spending is not responsible for the GDP growth in those years. Okay, you're confusing government spending with deficit spending. Even though government spending declined, as a percentage, the deficit as a percentage of GDP is what I was measuring, not absolute government spending. I was looking at it as a percentage of the deficit as a percentage of GDP. And if you look at nominal GDP growth, the deficit is pretty much responsible for almost all of the nominal GDP growth. 2024 spending will be like several $100 billion higher than 2023. Maybe government spending is responsible for this year's growth. Again, spending versus deficit spending. You got to just look at deficit spending. What could go wrong with your TLT trade? What could go wrong is just this behavioral aspect is where everybody starts agreeing that everybody else is right, and it gets a life of its own, and it becomes detached from reality. But everyone just keeps talking about it. That's the big risk. Expand on the relationship between marginal cost of capital and equity prices. On why an increase in MCC would increase equity prices. It wouldn't. If you increase the marginal cost of capital, you should decrease equity prices. T has mellowed out now. Is it? Oh, saying that after. Oh no. I hold both U.S. and Russian long bonds. Ooh, Russia. Russian central bank raised the rate 2% to 21% last Friday. They did that mostly to reduce inflationary effect of huge defense spending. Still consider a possibility of raising rates in December. I still think it will play out like in the U.S. after the war ends. I understand that it also depends on war ending on a good or at least neutral terms. A lot of people in Russia really want Trump to win as he's not keen on aid to Ukraine, so this risk might be reduced soon. Do you think your logic about U.S. duration can also be applied to Russia in some way? Well, duration is mathematical, right? It's theoretical, but it's mathematical. If you reduce yields, bond prices go up. So the question then becomes, is there a pathway to reduce yields? And if there is, well, then yeah, it'll work out. I don't know enough about the Russian economy to be able to answer that. Okay. Paul Tudor Jones, yeah. I've already commented on duration. And there we go. That is the end of that.